private markets are finally undergoing significant transformation. Transformation that we haven't seen in decades. And the structures that I've discussed today, they are facilitating that transformation, and they represent how capital will flow in private markets in the future. I think the days of set it and forget it 10-year funds are numbered. Investors want optionality, managers need flexibility, and market volatility means we need adaptive structures. Hello, and welcome back to another episode of GRC in Focus. I'm your host, Asad Bukhory. And today I want to talk about some of the innovative fund structures reshaping private equity. Now, if you've been following private markets lately, you've probably noticed that the old playbook, the traditional 10-year closed-end fund, is getting a makeover. We are seeing rolling funds in venture capital, so early stage investing, and we are seeing evergreen vehicles, parallel structures, and continuation funds reimagine how private capital operates. But what's the driver? Well, limited partners want more flexibility, general partners need more creative ways to hold assets longer, and there's a massive push to bring private markets to individual investors. For this to happen, though, we have to look beyond the traditional PE model, which I think is broken, but the industry has been slow to admit it. For decades, we've operated with this simple model. You raise a fund, you invest over 3 to 5 years, harvest returns over 5 to 7 years, and then return capital to investors. And then it's pretty much rinse and repeat. These closed-end funds, they're like clockwork. They are predictable and familiar, but frankly, I think pretty rigid for the increasingly more complex world, where investor needs have evolved significantly. Limited partners are asking, why can't we get our money out earlier? And you have retail investors who are questioning, why are they locked out of this asset class entirely? They don't want to be exit liquidity for institutional investors anymore, knowing very well that value creation typically happens in early stages. And then general partners are thinking, well, what if our crown jewels need more time? Now, add to this mix the market forces. Interest rates have been all over the map. Exit markets have been challenging. There's something like $4 trillion in portfolio assets sitting in private equity funds, 40% of which have been held for more than 4 years. So that's a lot of capital looking for more flexible solutions. And so this is creating a liquidity pressure that we can't ignore anymore. I think part of how we solve this is by looking beyond the traditional 220 playbook. So let's look at some of the structures reshaping private equity. I'll dive into their mechanics and I'll talk about what that means for the future of private capital. Okay, first up, rolling funds. These are what I call the Netflix model of private equity. The bolts and nuts of rolling funds, it's basically, instead of your traditional model where you raise a massive fund once and then you deploy it over a 3 to 5 year period, with rolling funds, they operate on a subscription basis with quarterly capital commitments. So every quarter, the fund manager can call capital for new investments. Each subscription creates what's called a series. So essentially, a mini fund within the larger rolling fund structure. Now, quick disclaimer, this is mostly a US phenomenon, okay? It's particularly common in venture capital. So inside the umbrella of the master fund, you've got these mini funds, one after another, usually set up as a Delaware limited partnership. Each series has its own pool of assets, its own portfolio, allocation, and so on, right? Now, what's appealing to investors is the flexibility. So no more being locked into a 10-year commitment on day one. Instead, you're deciding every quarter if you want to stick around. So you get to see the manager in action. Okay, so kind of being on a continuous test drive. And if an investor decides to sit out a quarter, that's absolutely fine. They're simply not in for that series. If a quarterly fund doesn't deploy all its capital within that quarter, the remaining balance automatically rolls over to the next quarter. So it's considered an additional capital contribution. But what's interesting, the rollover capital is not subject to management fees. Although I would say you do need to read the fine print because terms can vary by fund and by platform. The vintage diversification effect is pretty interesting because each quarter creates a new fund series. LPs automatically get exposure to different market conditions and vintages. Now, I think this can potentially reduce the concentration risks that comes with investing in a single vintage year fund. I mean, that's a pretty significant risk management benefit if you think about it. And it's something that I don't think traditional funds can offer. Rolling funds also solve the dreaded fixed fundraising period. Traditional fundraising can take, 18 months or maybe even more in today's market. Rolling funds allows you to raise capital continuously so you can adapt to market conditions without being held hostage by a single fundraising period during a market downturn. You basically get a steady capital flow, which allows you to take advantage of investment opportunities as they arise, rather than having to wait for the next traditional fund cycle, which technically means you get to adjust your strategies dynamically. So you can course correct in response to market conditions and investor demand. And this provides more agility than traditional closed-end funds. But just to be clear, rolling funds are not perfect, okay? There's a ton of administrative lift that's required. You have to deal with this, fundraising treadmill because it's continuous. You have continuous reporting, you have portfolio management for each series, and every quarter means more paperwork, more investor onboarding, new investment decisions, more due diligence, more monitoring, right? I think that's a lot to handle for a small manager, especially if they don't have, the right tech stack. And you also need to think about the subscription risk. If markets tank or the manager underperforms, investors can pull back, and this would leave less capital for new deals. So it's not a silver bullet. Right now, most of the rolling funds are in the US and they operate under Rule 506C under Regulation D. Managers can publicly advertise their rolling fund, but only to accredited investors. But there's growing interest in applying the model to growth equity. And we are seeing family offices and smaller institutions dip their toes in as well. And I can see this working in lower middle market buyouts where deal flow is steady enough to support this type of mechanism. But the model is it's still evolving. And as I mentioned, it's mostly in the US and predominantly used for early stage investing in venture capital. Next up, Evergreen Funds. So these are open-ended vehicles. They don't have a fixed lifespan, and they offer periodic liquidity while investing in traditionally illiquid assets. Frankly, I think they represent everything that traditional private equity should have been doing for the past decade. The mechanics are simple. Investors can typically subscribe monthly or quarterly. The fund offers redemption opportunities on a regular basis, usually quarterly. The key is balancing this liquidity with investments in private companies, real estate, and other illiquid assets that traditionally required 10-year lockups. And the way it works, Evergreen Funds maintain what's called a liquidity sleeve. Typically, 10 to 20% of the portfolio is held in cash and public securities. This sleeve serves a dual purpose. Firstly, it provides immediate liquidity for redemption requests, and secondly, it offers a place to park capital before it can be deployed into private investments. In the US alone, Evergreen Fund AUM has almost quadrupled from about 18 billion back in January 2020 to about 90 billion as of January 2025. Now that's explosive growth. And it happened during a period when traditional private markets fundraising has been declining. Hamilton Lane's analysis of 13 equity-focused evergreen funds shows that evergreen funds have done slightly better than closed and PE funds despite their short performance history. This suggests the structure itself might offer performance advantages beyond liquidity. It's worth highlighting that the number of semi-liquid products has almost doubled in the last 5 years to 520 funds at the end of 2023, with a combined market volume of at least $350 billion. These funds now account for nearly 1/3 of secondary market fundraising. For individual investors, evergreen funds, they solve the liquidity problem that has kept them out of private markets for decades. So no more 10-year lockups, no more unpredictable capital calls. If you invest, say, $100,000 today, you have a diversified private markets portfolio immediately. So basically, you can put all your money to work on day one, and this gives you the magic of compounding returns. Now, let's say your evergreen portfolio delivers 12%, okay, 12% return over 10 years, so nothing heroic. You'd expect to have, say, 2.5 times your investment after 8 years. For context, only about 6% of closed-end funds generate a 2.5 times TVPI, and they typically have IRRs above 20%. That's pretty amazing. Now, for managers, evergreen funds, they provide perpetual capital. No more fundraising treadmill, no forced selling when the timing is not right. So you can hold your assets for as long as it makes sense, compound returns over time, and build truly long-term value. Now, the problem is, cash management can be a real challenge. In evergreen structures, you need to maintain enough liquidity to be able to meet redemption requests, but while staying fully invested. Just to draw an analogy here, kind of being like, a bartender. So, you keep serving drinks while constantly restocking the bar. The liquidity risk means that during market stress, you might face a gating scenario where redemptions are suspended. So, not exactly the liquidity promise that investors sign up for. And we saw that firsthand with, some of the real estate evergreen funds during COVID-19. And so I think this, this highlights the structure's limitations during stressed conditions. NAV pricing is very important, and it can even sometimes become contentious. When you have monthly or quarterly liquidity, the accuracy and timeliness of your NAV calculation, it directly impacts investor treatment. Unlike closed-end funds where NAV is primarily for reporting, with evergreen funds, they require transaction quality valuations on a regular basis. Notwithstanding these challenges, though, the institutional adoption has been impressive. Some of the private markets managers, they've launched semi-liquid structures in recent months, And if you look at EQT, you look at Harborvest, you look at Partners Group, they've been offering semi-liquid products for years. And so we do have performance data to validate the model. In Europe, LTIF 2.0 has been particularly successful. Since the revised regulations took effect in January 2024, we've seen a surge in evergreen fund launches across Europe, with managers taking advantage of this distribution and pan-European passporting capabilities. I think semi-liquid evergreen vehicles can provide retail investors access to many of the benefits of private equity investing with a better user experience and potential for long-term compounded returns. And I think perhaps this could be the structure that finally democratizes private markets. You can check out my debut episode where I talk about the democratization of private markets. How do you access capital from European pension funds, Asian sovereign wealth funds, and US endowments when each group has different regulatory requirements, tax considerations, and preferences? Well, the answer is you create two or more funds, perhaps one domiciled in the Cayman Islands and another in Luxembourg, that will invest pari passu in the same assets with the same investment strategy, but each is structured to meet the specific needs of different investor groups. Welcome to parallel funds. The Luxembourg Cayman Parallel has become the gold standard for managers with global aspirations. Luxembourg offers EU investors the comfort of familiar regulations and the AIFMD marketing passport, while Cayman provides the flexibility and cost efficiency that non-EU investors prefer. Both vehicles invest and divest at the same time in a common portfolio of assets, usually on a pro rata basis per their commitments. Every investment decision, every distribution, and every governance matter needs to be synchronized across both funds. So this means synchronized capital calls and divestments, coordinated due diligence processes, shared deal documents, ensuring no vehicle can act independently, maintaining pro rata investment ratios, and unified decision-making frameworks with identical investment committees. The main benefit here is the expanded market access. Parallel funds, they enable fundraising from geographically diverse investor bases by addressing jurisdiction-specific requirements, regulatory, tax, and structural requirements. And this can significantly increase the total capital available to a fund strategy. We've seen funds use parallel structures to raise significantly larger amounts of capital than would have been possible with a single vehicle. Tax efficiency is crucial and often the determining factor. Parallel structures, they allow different investor groups to invest through vehicles that optimize their specific tax situation. Asian managers have shown particular interest in Luxembourg Cayman parallels when targeting both EU and Asian investors. But investor servicing can be costly with separate NAV calculations, investor reporting, and regulatory filings for each vehicle. You also need to think about how you're going to allocate your management fees, your carried interest, and the operational expenses between the two vehicles. And you also need to think about the ongoing monitoring in order to ensure fairness across, the parallel structures. And so all of this, they add to the cost. And then you also need to think, you need to factor in the jurisdictional nuances, and these can vary significantly. Luxembourg benefits from AIFMD compliance and the European marketing passport, while Cayman offers regulatory flexibility and cost efficiency. Now, AIFMD requirements in Europe means you must appoint an authorized AIFM, which allows the use of the pan-European marketing passport to professional investors. As global capital flows evolve, I'd expect continued innovation in parallel fund structures. Geopolitics mean we will almost certainly need more sophisticated multi-jurisdictional approaches as managers seek to maintain access to diverse capital sources. And I think new fund domiciles, particularly in Asia and the Middle East, could give rise to more complex parallel structures involving 3 or more jurisdictions. Okay, let's move on to continuation funds. I think they are solving a problem that the industry created for itself with arbitrary timeline constraints. Continuation funds are typically GP-led secondary transactions where a manager transfers select assets to a new vehicle rather than selling them to a third party. The typical scenario is usually a GP with a trophy asset in a fund that's nearing the end of its life, where traditional exit markets become challenging, but the GP believes the company has significant upside remaining. So instead of selling to a strategic buyer at what might be at a discount, they will transfer the asset to a continuation fund. Existing investors get a choice. They can either take cash now based on a valuation established through a competitive process, or they can roll their investment into the new vehicle and potentially participate in future upside. New investors, typically secondary buyers, they can come into the continuation fund, often at a slight discount to the previous valuation. So you can have single asset continuation funds. So these focus on one specific asset, allowing managers to concentrate their efforts, or you can have multi-asset funds. And so these offer diversification. Evercore's 2024 research shows about 55% of GP-led secondaries involved single assets continuation funds. Now, with continuation funds, the main issue is valuation. This typically involves a competitive auction process to ensure market-based valuations. William Blair's 2025 survey found that 67% of large cap GPs completed or marketed a GP-led secondary transaction, while 31% of mid-cap GPs did the same. Repeat sponsors represented 42% of 2024 volume, so this shows continuous funds are becoming a standard tool rather than a one-off solution. For GPs, continuation funds solve the exit timing mismatch that has plagued the industry. Traditional private equity structures, they often force sales at inopportune times due to fund life constraints. Continuation funds allow GPs to optimize hold periods while providing LP liquidity options. Single asset continuation funds are often used by managers who wish to extend their hold on high-performing portfolio companies beyond the typical PE fund life cycle, so offering additional time and capital to achieve growth objectives. For existing LPs, continuation funds provide valuable optionality that simply didn't exist before. They can, they can cash out if they need liquidity or if they have concerns about future performance, or they can stay invested if they believe in continued upside potential. Again, this choice was not readily available in traditional exit scenarios. New investors get access to assets with established track records. Unlike traditional primary investments where you're investing in a blind pool, continuation funds allow investors to see exactly what they are buying and they can analyze historical performance. But you have to be aware of the governance concerns, okay? The main one is conflict of interest. So how do you manage that? I mean, how do you ensure fair valuation when the same GP is both the buyer and the seller? Well, the market has evolved to address these concerns through robust valuation processes, increased LP approval requirements, and sophisticated pricing mechanisms. The market has learned from the early criticism. So the transaction terms are now becoming more sophisticated and transparent. But managing multiple stakeholders is still challenging. Continuation funds require coordination between existing LPs who, must decide whether to cash out or to roll, and new investors who are evaluating the investment, and the GP who is executing the transaction. Now, the regulatory landscape shifted significantly on the 5th of June 2024, when the US Court of Appeals for the Fifth Circuit unanimously vacated the private fund advisors rules that were adopted in August 2023. The court held that the SEC exceeded its statutory authority and that no part of the rules could stand. But this doesn't mean that regulatory scrutiny has decreased. In fact, I'd say the opposite is true. The SEC retains significant regulatory authority through existing tools. They are continuing aggressive examination and enforcement under existing Advisors Act provisions, particularly targeting conflicts of interest in continuation fund transactions, valuation procedures, and fairness considerations, and fee allocation and transparency issues. All continuation fund activities remain subject to existing fiduciary duty requirements under the Investment Advisors Act, plus the Form PF amendments remain fully effective. They require quarterly reporting of GP-led secondaries, giving the SEC unprecedented transaction visibility. Now, what's interesting is the market response. Despite the rule being vacated, many industry participants are voluntarily adopting PFAR-style practices as market standards. Fairness opinions remain common in GP-led transactions. We still have enhanced disclosure, and we have better conflict management procedures, even without the formal rules in place. The ILPA has issued guidance on GP-led secondaries, providing best practices for both GPs and LPs navigating these transactions. The market is projected to continue to grow, backed by several tailwinds: continued demand from LPs for liquidity solutions, stronger pricing environment, continued expansion into additional asset classes, and an expanding buyer universe supported by retail capital vehicles. Now, let's look at co-investment platforms. These platforms are changing the GP-LP relationship dynamic. Instead of just investing in a blind pool fund, LPs get to invest directly alongside GPs in specific transactions. Basically, co-investment platforms are democratizing access to deal-level investing. So if you are an LP, you want to pay attention, because these investments typically come with no management fees and no carried interest. You basically just pay your pro rata share of deal costs. Fundraising for co-investment focused funds has quadrupled over the past decade. And this is how it works. When a GP finds a great deal that's larger than their fund can handle alone, they offer co-investment opportunities to their LPs and other qualified investors. Nowadays, we have modern co-investment platforms that are combining primaries, secondaries, co-investments, and growth equity strategies. That's great because this creates synergies across different investment approaches. Now, what's interesting, digital platforms now provide streamlined due diligence processes, automated subscription management, real-time reporting, and portfolio monitoring tools that make co-investing more accessible to a broader range of investors. Typically, an average, say, $11 billion global buyout fund will attract $2 billion in co-investment. and offer maybe 6 co-investment opportunities. This is a significant proportion of total deal value being financed through co-investment capital. Many institutional LPs now reserve between 15 to 30% of their total private investment allocation for co-investment opportunities. And co-investment has become a strategic tool for GPs dealing with challenging fundraising environments, with fund closing times becoming longer and some firms choosing to close with smaller fund sizes than initially targeted. Co-investment capital has emerged as a way for incentivizing new commitments and extending deployment runway. I think for LPs, the value proposition is obvious. Firstly, you have enhanced returns through reduced fee drag. So co-investments typically have no management fees and no carried interest. So this improves net returns. And then secondly, you have direct exposure to a specific company. So this provides transparency and control that is not necessarily available in blind pool funds. The other thing to mention here is the relationship building aspect. And I think that's undervalued. Co-investing alongside GPs creates deeper partnerships and provides insights into the GP's investment process, deal sourcing capabilities, and value creation approach. Now, this intelligence can inform LPs' future fund commitment decisions. For GPs, co-investments solve several challenges. Capital access for larger deals. So when you find a great opportunity that exceeds your fund's capacity, co-investors provide additional equity. There's also the LP relationship. Successful co-investments strengthen relationships and increase LP satisfaction. The platform approach is gaining traction. For example, Moonfair offers co-investment opportunities alongside GPs, allowing clients to invest in selected deals with a shared interest. This democratizes access to deal-level investing that was previously available only to large institutional investors. But co-investing is not for everyone, okay? It requires significant due diligence capabilities that, frankly, many LPs lack. You need the ability to evaluate deals outside your core area of expertise, and you need to make investment decisions pretty quickly, often within 3 to 4 weeks of being presented with an opportunity. And there's also the selection bias. GPs preferentially offer their best deals to their largest LPs, or they keep the most attractive opportunities for their own funds. So co-investors need to understand this dynamic, and they need to evaluate opportunities accordingly. If you're running co-investment programs, you need systems to handle deal-by-deal subscription processes. You need separate reporting for each investment, different legal documentation for each deal, and ongoing monitoring of individual company performance. Unlike diversified fund investments, co-investments create concentrated exposure to individual companies. So this requires sophisticated portfolio construction and risk management capabilities that, again, investors underestimate. Now, let's look at fund of funds. Look, traditional fund of funds have been getting their lunch eaten for years. And I think the criticism is fair. Double fees, questionable value add, and frankly, a lot of them were just, lazy diversification plays. But a specialized fund of funds that actually solve specific investor problems, they are in demand. The key is providing access, not just diversification. I'm talking about entry points to investment opportunities that individual LPs can't efficiently access on their own. So where are these specialized fund of funds thriving? First, you have oversubscribed funds. There are funds out there that are so hot, they close their fundraise after a few phone calls only. So if you're not already in the network, sadly, you're not getting in. But a specialized fund of fund with long-standing relationships can secure allocations that are otherwise impossible to access. And then second, you have emerging markets. Individual LPs, they typically lack the resources, the local networks, and they don't have the boots on the ground presence to be able to identify and diligence dozens of local managers in places like say Southeast Asia or Sub-Saharan Africa. But a specialized fund of fund, they can provide curated access to these ecosystems. And then thirdly, you have emerging manager programs. Some fund of funds, they focus exclusively on first-time and second-time fund managers. These managers, they often have really unique investment thesis, whether it's specific sectors, geographies, or communities that they understand better than anyone else. Now, let's talk about fees because, the double fee hasn't gone away. Traditional fund of funds, they typically layer a, something like 0.8% management fee plus 5% carry on top of the underlying fund expenses, totaling upwards of 2% per annum. That fee drag is precisely why some allocators turn away. But now, some fund of funds have started experimenting with performance-based models like founders carry or deal by deal carry calculations, where managers don't just wait years for pooled fund return. I think these innovations create immediate alignment and can potentially offset early vintage performance challenges. But to be clear, deal by deal carry is still emerging, okay? And it's more common among niche vehicles and syndicate type structures. But we are seeing a shift toward investor-friendly economics. Now, operationally, specialized fund of funds can deliver massive leverage. A typical program holding 20 plus primary funds will give you exposure to some 400 plus portfolio companies. So collapsing what might be 500 plus capital calls, dozens of tax packets into a handful of line items over a few years. For many institutional investors, that's outsourced CIO for private markets done efficiently. But I think the most overlooked value proposition, it's risk management and scale. You need upwards of 20 to 50 fund relationships for true PE diversification. Now, for most of us, except perhaps, the absolute largest institutions, building that kind of scale on our own, that's a pipe dream, okay? But the best fund of funds can deliver that. Plus, they can give you portfolio analytics, compliance, and often lobbying muscle in investor negotiations. Now, let me give you some statistics. Fund of fund assets grew 58% from 2020 to 2023, outpacing the 42% growth in traditional open-end funds. First-time funds show higher upside and broader variance, meaning manager selection is everything. Only about 1 in 8 emerging managers receive backing, so fund of funds must be dead on with due diligence to avoid the lower tail. And because no structure is perfect, you have to remember that fund of funds add operational complexity, and they require intensive due diligence and additional reporting obligations. Dispersion in emerging manager returns is brutal. There are some home runs and plenty of strikeouts. The best fund of funds mitigate this with proprietary data and relentless manager selection. So in short, old school lazy fund of funds are deservedly on the back foot, but the sophisticated fund of fund are thriving. They're providing real value in an increasingly barbell-like ecosystem where access, scale, and smart risk-taking beat simple index replications. Now let's look at separately managed accounts. These are exploding. They offer bespoke capital solutions, highly tailored strategies for single investors, and they are growing even faster than traditional co-investments. Some family offices are essentially hiring GPs to run bespoke investment programs just for them. The attraction here is you're getting a customized fund structure that meets your specific needs, timeline, and investment criteria. If you are a large institutional investor, I think the appeal is obvious. You get complete transparency, direct control over investment decisions, customized reporting, and fee structures that can be optimized for your specific situation. For a sovereign wealth fund with, say $50 billion to deploy, the economics of a separately managed account can be very compelling. For GPs, separately managed accounts solve several challenges. They provide dedicated capital from sophisticated investors who understand the strategy. They often come with longer commitment periods and more patient capital. And frankly, they can be more profitable than traditional fund structures when you factor in the reduced operational complexity of serving one investor instead of hundreds. But you need systems to handle separate investment tracking, customized reporting requirements, individual legal documentation, and dedicated investor relations. But I think for the right relationships, it's totally worth the investment. Now let's talk about club deals. Club deals are also surging. These allow LPs to participate in larger deals and share due diligence costs while maintaining direct exposure to specific investments. For GPs, club deals are basically a way to pursue opportunities that might be too big for their fund size. So instead of passing on a great deal because it exceeds your fund's capacity, you syndicate it to other managers and co-investors. Everyone contributes capital, shares due diligence, and participates in the upside. Obviously, club deals have their challenges, but when club deals work, they create opportunities that wouldn't exist otherwise. Large-scale infrastructure projects, major corporate carve-outs, and complex cross-border transactions often require more capital and expertise than any single fund can provide. So club deals make these opportunities accessible. I think the due diligence sharing aspect is often underappreciated. Instead of each participant conducting separate due diligence, club deals allow a specialization. So you have one participant might lead commercial due diligence, for example. Another one can maybe handle, regulatory analysis, and maybe someone else focuses on operational assessment. And so this creates better outcome while reducing cost for everyone. And finally, we have warehousing structures. These solve a practical problem that every GP faces. Sometimes you need to move quickly on a deal, but your co-investment vehicle is not set up yet. Or maybe you haven't allocated the opportunity to co-investors. So the main fund temporarily holds the investment until it can be formally syndicated to the co-investment fund or other participants. The co-investment fund typically pays interest to compensate the main fund for the capital cost. But you need systems to track temporary holdings, calculate appropriate compensation for capital usage, manage the transition from warehouse to permanent structure, and ensure regulatory compliance throughout the process. If you get warehousing wrong, you're looking at serious regulatory issues and potential LP conflicts. Bear in mind that regulators are scrutinizing warehousing arrangements, particularly conflict of interest management and appropriate compensation mechanisms. But done right, warehousing enables speed and flexibility that traditional structures can't match. When a great deal comes along and you need to move fast, warehousing allows you to secure the opportunity while you organize the permanent financing structure. To wrap up, private markets are finally undergoing significant transformation that we haven't seen in decades. And the structures that I've discussed today, they are facilitating that transformation, and they represent how capital will flow in private markets in the future. I think the days of set it and forget it 10-year funds are numbered. Investors want optionality, managers need flexibility, and market volatility means we need adaptive structures. I expect we will see continued innovation around maybe semi-liquid products, more sophisticated liquidity management tools, and hybrid structures that combine the best elements of different approaches. We are probably 3 years away from tokenized fund interests becoming mainstream. I say this as someone who has previously explored tokenization of litigation funding receivables. So, as retail investors flood into private markets, regulators are going to need to adapt quickly. So I expect more sophisticated investor protection frameworks, enhanced disclosure requirements, and maybe even some structural reforms. But the common thread running through all these innovations: flexibility, transparency, and responsiveness to investor needs. These structures, they're not just about being different. They solve real problems for both GPs and LPs, and they are creating new opportunities that frankly didn't exist under traditional structures. So whether you are a GP looking to differentiate your offering, or an LP seeking better terms and flexibility, or maybe an advisor trying to understand where the industry is heading, these structures are the new playbook for private capital. That's it for today. Thanks for listening. And don't forget to hit the subscribe button if you are finding this content valuable. I'll see you next week for another fresh perspective. Until then, stay compliant.